Okay, good afternoon, everyone, and welcome back to our options education webinar series. Today, we're here to go over how to hedge a portfolio using options. This, in my opinion, is quite a timely subject given the current market conditions that we've been in. We had a huge sell-off in the end of last year. I actually did one of these webinars right before that sell-off in October. And I remember getting a lot of emails from users saying that was quite a timely webinar and being able to understand how to protect your portfolio against a downfall. And that was purely by coincidence. And we happen to find ourselves in a similar market condition where the markets have had this strong rally over the last few months since that December low. And it's certainly overbought and starting to turn around a little. And it could be a small correction of just a couple of percent. It could be much larger. So today, what we're here to talk about is, if you have any concerns about a correction, anything greater than 3 to 5% in the market, anytime in the future, not just now, but perhaps 6 months down the line or a year down the line, perhaps when the next recession does hit, how do you actually go about remaining invested in the market, but being able to hedge yourself? And options is a great instrument for doing so. And there's lots of different ways to hedge your portfolio. So today we're going to talk about the best practices for efficiently hedging a portfolio, what tools you can use to analyze a hedge, and lastly, determine if it's even right for you. And the reason for that is because hedging is useful in certain cases, but in many other cases, there are better ways to hedge your portfolio. So we want to talk about all of these things here today. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. This webinar today is recorded, so you will get the recording with the slides after we finish here today. So just to get a bit of housekeeping out of the way, I do want to remind those of you that are brand new to Options Play, welcome. If you after we finish today, if you want to take a look at the platform that we'll be showing the demonstration on, you can sign up for a free 30-day trial at optionsplay.com. The membership is $50 a month or $500 a year. It will give you access to all the weekly educational webinars like the one we're doing here today, daily trade ideas. And if we come across any topics that you are unfamiliar with or terms that you want to learn more about, I highly recommend people to take a look at the Options Industry Council. So I'll send out the slides with the recording after this webinar so that you can click on some of these links if you need to learn more about options trading or about our company. Now, before I get into the hedging piece, I do want to tell everyone I'm unfortunately going to have to cancel the webinar next week. So we'll be resuming that topic the week after on, I believe, the 21st. So the webinar next week on the 14th, unfortunately, I will be traveling, so I won't be able to do it. So we're going to push that out one more week for those of you that attend our webinars every single week. So with that, let's go ahead and get started. Today, we're going to go over a few different things. We're going to start off by talking about what is a portfolio hedge, because I want to define that, because hedging is something we may conceptually understand, but when it comes to the actual practice of how do you actually hedge a portfolio, I want to define that, make sure everyone understands that. Then what I'll do is I'll talk about the different vehicles you can hedge a portfolio with, what the difference between index versus ETF options. Many of you probably have traded ETF options. Some of you may trade index options. I want to talk about the difference and what are the benefits of each one. Then I want to talk a little bit about who should actually use a portfolio hedge, because it's not for everyone. And I think you'll find that for many people, you'll actually find that there's a much better hedge than putting on a put option to hedge your portfolio. So I want to make sure everyone understands that before we go any further. Then what I'll do is I'll start talking about some real examples, a real portfolio, putting the different hedges on, whether you're looking for catastrophic insurance or comprehensive insurance on your portfolio. We'll talk a little bit about the differences and what you can expect of each one. We'll go over best practices for when to enter and exit your hedge. And lastly, what we'll do is we'll try to spend as much time as possible showing you some real analysis of options play with specific hedges, because the goal here of this whole webinar is that after we finish here today, I want to make sure everyone is self-sufficient at the end of this webinar to be able to put on and analyze your own hedge using options play. So that's what we're here to do today. Now, what I'm going to start off by talking about is a portfolio hedge. Now, I want to start off with a poll before I get into it. How many of you are concerned about a market correction greater than 5% over the next couple of months? I just want to get an understanding of the users here on this webinar. Okay, so over 70% of you have voted already, and it's pretty clear here. You know, about 2/3 of you say that you're concerned about a correction greater than 5%. 30 of you said no, which is actually quite high, but I think that's fairly reasonable because a 5% correction does get us back to, in my opinion, to a fairly normalized level. And 6% of you say, I'm not sure. I'm actually surprised that more of you are not saying I'm not sure, because I'm certainly not sure myself. So what I do want to bring up is a chart. Here's a chart of the S&P 500. This was the massive sell-off that I was talking about starting in October. I remember doing this webinar, I think it was on October 4th, actually, was the day I did the hedging webinar. As you can see, it was right near that top, and I got a lot of emails from users saying, wow, you know, I happened to have put on a hedge the day after, and I was really able to protect myself. Again, that was pure coincidence on the day that I did it, that's when the market started to sell off. But as you can see, the market has really had this really strong rally of pretty much a one-directional move from that 233 low all the way back up to 280, which is a spectacular move. But as you can see, this 281 or 282 level was a triple top back here in October, in November, in December, and again, a bit of a double top here in late February and early March. And as if you look at any momentum indicator, they've started to turn lower again, showing that momentum is likely going to start reversing lower. So as you can see, there is some support around 260. That happens to be exactly about a 5% pullback from where we are. So in my opinion, I think the markets conservatively can move at least about 5% to the downside before finding some real support. And that's healthy of a market. It's not healthy for a market to move straight up. There's likely going to be a pullback. Perhaps more, the economy I feel is pretty healthy. Corporate earnings are not that bad, or certainly have not deteriorated to a certain degree that would suggest that we're going into a recession or anything like that. Things have certainly slowed down, and we do have some binary risk. We have Brexit coming out. We have the trade wars that are still a bit pending. So there are certain risks that may suggest that this could move lower, but I think at least a pullback to 260 is probably modest. So I don't know that this is necessarily the type of environment that requires everyone to hedge their portfolio, but the goal of this webinar is to prepare you so that in the future, if you do feel that the markets are going to make a big correction, that you have the tools and you know how to go about putting on a hedge for your portfolio. So with that, let's just jump right back into what is a portfolio hedge. It's very simple. It's simply you can think of it as an insurance policy against your portfolio, and it insures your portfolio during a market correction and protects you against a significant downside on the markets. And you can create this portfolio hedge by buying a put option on a broad-based index, ETF or index option, any index or ETF or tradable instrument that's highly correlated to your portfolio. You can buy a put option on it, and that will create a portfolio hedge. And the hedge itself is not necessarily protecting you. What you're doing is you're buying a put option, and that put option will profit as the market sells off, and the gains that you have in that long put will offset the losses that you have in your portfolio. And what this creates is what we call an imperfect partial hedge, meaning you're never going to get dollar for dollar compensation for any downside. You're going to get close to dollar for dollar, or the goal is to get as close to dollar and dollar, but you're never actually going to get there. And the one thing I do want to point out is we talk about this as being an insurance policy, but I want to make sure everyone understands that this is expensive. Buying the portfolio hedge is not cheap. you will create a portfolio drag if you try to constantly buy insurance on your portfolio. Because a lot of people think about insurance policies that you have on your car or your home. You just continuously buy insurance policies, and if anything goes wrong, you get paid for it. And you think, why shouldn't I do that for my portfolio? The answer is the fact that it's so expensive that if you simply bought insurance all the time, you would constantly underperform the market. So that's why it's something that you really have to time based on when you feel the markets are going to correct, and it does require active management and timing. So again, this is part of the reason why portfolio hedges is not for everyone, but it is for specific scenarios. So today we're here to explore what those scenarios are so that you are implementing them correctly. So before we move on to the next slide, what I do want to have a sense for is, if you did feel that the markets were going to correct, how would you go about protecting yourself? Before you saw this webinar, if you felt that the markets are about to correct, how do you actually go about protecting yourself? Do you move into cash? Do you hedge with some kind of derivative like futures or options, some other strategy, or you're not sure? Okay, very interesting mixed bag of results here. Moving into cash 30%, hedge my portfolio of futures and options 32%, I'm not sure 28%, and 10% of you said other. So very, very mixed bag here. As you can see, I would say it's almost a very equal distribution here. And this is really what we're here to explore, is what are the different options, what are the use cases of each one, and making sure that you use the correct one. So let's go ahead and dive right into it. So with respect to buying portfolio insurance, what you're doing is you're buying a put option. And the question is, what do you buy a put option on? And the two main categories of put options that you can buy are index and ETF options. Index options, in my opinion, can offer you some cost and transaction efficiencies over ETFs. However, index options typically are very large, so they're only suitable for relatively large portfolios. So if you do have a relatively large portfolio, index options are cash settled options. What that means is that you can buy a put option, and near expiration, you don't have to close out that trade. Whatever profit that you have on that put option will be settled in cash. You don't have to worry about taking delivery of anything or being short the stock as a result of it or having to deliver any stock. It just simply is settled in cash, which reduces your transaction costs because you don't have to close out that position. And this produces some efficiencies in being able to trade cash settled index options. So that's one benefit, if you will, for trading index options. Index options also are European style, which means there's no early assignment risk. This isn't really a problem for buyers because you don't have assignment risk as a buyer, but it's something to consider that you don't have to, there's no ability to exercise early, even if you wanted to. Lastly, the one thing that I do think that is favorable to index options is the fact that most hedges are put on for a relatively short period of time, which means that if you're in a taxable account, you will be paying short-term capital gains if you're trading ETF options. But for index options, you have favorable tax treatment. Index options are taxed the same way futures options are, futures are. So 60-40 tax treatment, 60% short-term capital gains, 40% long-term capital gains. So you do save yourself a little bit of money on capital gains if you are trading this in a taxable account. So those are three, in my opinion, benefits to trading index options. However, index options, generally speaking, are only suitable. They have very large contract sizes, and they're generally only suitable for portfolios greater than $250,000. If you have a portfolio greater than $250,000, index options provide you with these benefits, and you can trade index options by trading a couple of contracts, versus if you're trading ETFs, you might have to trade a few hundred contracts to get to your portfolio hedge. So depending on your portfolio size, that's typically what drives the difference between trading index options versus ETFs options to hedge your portfolio. So what is a portfolio hedge? And I want to make this clear because portfolio hedges mean a lot of different things. You can hedge with a put option, you can hedge with futures, you can move into cash. There's lots of ways of doing this. So what is a portfolio hedge in the sense of what we're describing here today? So first of all, what a portfolio hedge must first start with a stock portfolio. So any equities portfolio, doesn't matter whether you hold one stock or 100 stocks, doesn't matter whether you hold ETFs, mutual funds, individual stocks, as long as you have an equities-based portfolio, this is what you can put a hedge with. Now, the thing about a portfolio or a stock portfolio is the fact that you have symmetrical exposure, as you see in this chart. What I mean by symmetrical exposure is that you have unlimited profits to the upside and unlimited losses to the downside. You get dollar for dollar exposure. If the market goes up by a dollar, you make a dollar. If the market goes down by a dollar, you lose a dollar. And the goal here is to simply maximize your return by minimizing your losses. And you can trade a stock portfolio either on margin or cash. So what is a portfolio hedge? A portfolio hedge is simply buying a put option on that portfolio you're referring to, or rather in addition to the portfolio that you already own. And buying this put option provides gains as the asset prices fall. So as the market corrects and moves lower, it provides gains. The put option provides gains. This put option typically will cost anywhere about 1 to 5% of the underlying portfolio. So think about that for a second. If you had a home, let's say your home was worth $1 million and you had to insure it based a year for, or rather a few months for either $10,000 to $50,000 a month. Is that an expensive home insurance? I would say that is. So think about how much you pay for your home insurance or your car insurance. What percentage of the value of the asset that you're insuring are you paying in a monthly basis? Because portfolio insurance for a couple of months usually costs 1 to 5% of your portfolio. So a very large amount actually, which is why it's so expensive. And what this provides you with is limited risk, but unlimited potential gains. So that if the market corrects, maybe it really falls like 2008, falls by 50%, you have unlimited upside gains on the long put, but your risk is limited to what you've paid for that put. So no matter what happens, you will never lose more than the 1 to 5% that you paid for that insurance policy. So the combination of the stock portfolio and the put option that you buy is what we call a hedged portfolio. This is your portfolio plus that put option. And as you can see, the payoff graph looks quite similar to a call option. And that's really what a synthetic put is actually that before puts were traded, you could trade a synthetic put through short stock and selling a call. And this is really what the basis of put call parity comes from. So this hedge portfolio gives you unlimited potential upside exposure. So you still have upside exposure. If the market continues to move higher and it doesn't correct, you still participate in unlimited upside as long as the market continues going higher. But now you have limited downside exposure. And that's really the key here, is being able to have access to both the upside, but limited cap losses to the downside. And that's the goal of a hedge portfolio. So who should use a portfolio hedge? This is really where I want to spend a little bit of time making sure that people understand that there are alternatives to this strategy. So when I asked the poll here before, what strategies would you use if you felt that the markets are going to correct? And 30% of you said you would move to cash. And that is, in my opinion, what we call a perfect hedge. Meaning, if you felt the markets are going to correct, a perfect hedge is simply moving into cash and reinvesting that money once you felt the correction was over. So this is what we consider the best way to hedge a portfolio. However, not everyone has that the ability to move into cash. Perhaps you have stocks in your account that you have very low cost basis on, and you don't want to move into cash because that means that you have to pay a huge tax bill. Or perhaps you have some stocks that you rely on the dividend for income, and you don't want to move into cash because you lose that income stream. So these are all reasons that someone may not want to move into cash. So what is an alternative? The alternative is this portfolio hedge that we're talking about. The portfolio hedge is where an investor with a portfolio of stocks or ETFs to protect against a correction greater than 5%, and you do not wish to sell any of your holdings. In that particular case, that's when you want to put on a portfolio hedge, buying a put option against the stock portfolios that you own. So what is it? So now that if you've determined that moving into cash is not something you want to do, that you want to buy a put option, you know it's expensive, but it's a strategy that allows you to stay invested, but also protect yourself in the case of a major correction. How do you actually do it efficiently? And there's a few different things that we want to look into. Number one, we have to make sure that you do the timing correctly. So this is actually where, from my perspective, because of how expensive it is to buy a portfolio hedge, as far as entry goes, it actually makes sense to be a little late and enter the hedge during a correction, as opposed to trying to anticipate a correction. Because if you're anticipating a correction, you're effectively paying for insurance during a time that you may not need it. And that will cause a huge portfolio drag on your portfolio. Next, as far as exiting the trade, you want to exit whenever the correction is over or when you see volatility peak. So if any of you have used the VIX or any volatility-based indicator, you'll see that they peak. It's a very extreme peak near the bottom. So if you want to look at the December 24th lows and look at the VIX, you see that peak very clearly on December 24th. Whenever you see those peaks, that's when it's time to immediately exit your correction. So those are different ways to time your hedging strategy so that you're only in it when you absolutely need it. As far as a hedging instrument, number one, you want to make sure you pick an index that's closely correlated to your portfolio. So take a look at your portfolio. Most brokerage firms provide you with a way to look at your portfolio and understand what it's consisted of. Is it a fairly diversified portfolio? Is it primarily large cap? Is it concentrated in small cap? Do you have concentration in specific sectors? And understanding that will help you pick a better instrument to hedge with. So if you have a fairly diversified portfolio, maybe you own a bunch of ETFs, then you might want to just use a broad-based index like S&P, NASDAQ, Dow Jones, those types of ETFs or indices. If you have a very, let's say, tech-heavy portfolio, then you might want to use the Qs or maybe even XLK, one of the sector portfolios. And if you just have concentrated stock position in a single stock, then you may even just want to buy put options on that stock alone. There's lots of different ways that you can pick it, and I do recommend that you take a look at some of your broker's tools that help you identify the makeup of your portfolio, and that will also help you figure out what is the right index to trade. Now, as far as figuring out how much to trade, this is really where it depends on the size of your portfolio. So if let's say you have $1 million portfolio, you might want to hedge with NDX, which is the NASDAQ 100 full index value. If you have a portfolio greater than 200,000, you might want to look at SPX, the S&P 500 index option might be a suitable vehicle. And if you have a small portfolio, about $25,000, perhaps SPY, the ETF, is a bit more suitable. So picking an instrument based on the size of your portfolio is also something you want to consider. So next, what I want to talk about is once you've figured out that you want to place a hedge, you figured out which index or which instrument's right for you, how do you actually determine how many contracts to buy? And the formula is actually really simple. And I'll show you how Options Blake does the calculations for you so that you don't have to actually do it yourself. But I just want to make sure that everyone understands how we derive this number. So the number of contracts that you need to trade is simply the portfolio value, meaning the dollar amount of your portfolio, divided by the index value or the price of the index or the price of the ETF, divided by 100. That will tell you the number of contracts to sell. So if you have a $50,000 portfolio, if you were trading the Qs ETF, which is trading at around 173, you need about 2 contracts to do it. A $200,000 portfolio, 11 $500,000 portfolio, 28, 57, and 289 for these $1 million and $5 million portfolios. So I have a fairly wide range of portfolio values up here. And as you can see, as you get higher and higher, you start to trade a significant amount of the ETFs. At $1 million, you're trading 57 contracts. That's a lot of contracts to be trading. And if you're paying per contract fees, that might add up to quite a bit in terms of transaction fees. So as you get into the larger portfolios, it makes sense to start taking a look at some of those indices. So the NQX, which is 1/5 the value of the full NASDAQ 100 index, is about 1,400. So that's suitable for portfolios greater than about $200,000, $250,000. As you can see, if you have a $1 million portfolio, you can trade 7 contracts of this as opposed to 100, instead of 57 contracts of the ETF. That will significantly reduce the number of contracts that you're trading and the transaction costs. And lastly, if you do have a very large portfolio, that's when you might want to trade the full index value, which is around 7,000. So that is a notional value of about $700,000 per contract. So again, really suitable for portfolios greater than $1 million or more. More so for the institutional trader or perhaps financial advisor who's managing a larger account. So really look at the size of your portfolio to determine which vehicle is best suited for you. So picking an expiration date. Expiration dates are, in my opinion, relatively easy because most corrections happen relatively quickly, especially if any of you have caught my webinar at the end of January where I talked about the statistics of bull and bear markets. We really dived a little into, how quickly bear markets and corrections happen. They happen very quickly. Most of them do not last more than 2 to 3 months. So when you're picking expiration dates, you don't have to go much longer than 2 months. But when you do go longer than 2 months, you do minimize time decay, which is one of the factors that are working against you when you're buying a hedge. So we usually do tell you that when you're buying a put option or a hedge, you want to use longer dated options, about 2 months or further, because the time decay is going to decay slower, which means that you have a little bit more time for that market to correct. But the goal here is to only stay in this trade for as long as you need to, meaning as long as the market is correcting, that's when you want to hold on to it, but you want to get out as soon as possible. So even if you buy a 3-month option and the market only corrects for 3 weeks, you want to get out at the end of those 3 weeks. You definitely don't want to hold it for the 3 months. And the last thing I want to talk about is strike prices. This is really where I think there's a lot of different use cases for put options, and depending on what your views are in the market, that's how you're going to determine which strike price you're going to use. And there's 2 major types of hedges that you can utilize, and that will help you determine what strike prices to use. So just like an insurance policy, you can buy catastrophic insurance, which insures you against a severe loss or a major catastrophe, or you can buy comprehensive insurance that basically covers you for everything. And you can think of put option as the same thing. So when you're looking for a catastrophic insurance on your portfolio, that's when you're really trying to insure yourself against a major downside correction. Think about 2008, think about the dot-com sell-off. These are the types of major corrections that you're trying to protect yourself with a catastrophic insurance. This is when you're buying out of the money puts. So puts that are lower than the current price, about a 30 to 40 delta is usually a good starting point. And for a few month hedge, a three-month hedge, this will usually cost you between 1 to 3% of the underlying portfolio's value. So if you have a $1 million portfolio, buying a 3-month put option will usually cost you anywhere between $10,000 and $30,000, depending on when you're buying this protection. And then on the other hand, if you want more comprehensive coverage, meaning you want to just protect yourself against any downside protection, any correction, whether it's 5%, 7%, even smaller than that, maybe even just 3 to 4%. You can certainly do so. It's going to cost you a lot more, but this is where you buy in the money put option, so about 50 to 60 delta, and this will cost you roughly about 3 to 5% of your portfolio value. So what I want to show you guys is these 2 types of hedges side by side, show you how they perform so that you can make the decision as to which one's best suited for you, because I think that what I'm going to show you may not be as intuitive and may not be what you're expecting. So first, I'm going to talk about the catastrophic insurance. I have a hypothetical $1 million portfolio. In this particular case, I'm going to use NQX, which is a NASDAQ 100 index option. And we're going to look at buying catastrophic coverage on this portfolio, meaning we're trying to protect ourselves only against a big move against the market. So here on a $1 million portfolio, using that calculator I just showed you before, we're going to buy 7 contracts of a 2-month 30 delta put. That's going to cost me $17,500, which is 1.75% of the portfolio value. So 17 grand to insure a $1 million portfolio. And what I have here is simply the portfolio losses here, or the gains and losses in the second column. I have the options hedge in the third column, and then I have the net portfolio here on the right. So I want to show you how this performs. So if you look at the portfolio, an unhedged portfolio, if that $1 million portfolio, if the market moves up 5%, I make $50,000, moves down 5%, I lose $50,000, $100,000, $150,000 as the market sells off. So let's take a look at how that option hedge performs. If in the case that this market does not move, I actually lose 100% of what I paid for on the hedge. So I lose the $17,500. So my net loss on the portfolio is I'm down 1.75% or $17,000. If the market goes down 5%, so not a large move, but a modest move down, I'm still actually going to lose money on the put option because this is an out of the money put option. The market needs to move a fair amount before the strategy is profitable. So I basically break even on the put option, which means that I have almost no hedge at all. I actually lose a little bit more money on my hedge than if I didn't hedge at all. And as you can see, only when the market starts to move significantly lower, 10%, 15% lower, does the hedge start to provide gains. So if the market does move 10% lower, that's when I have about a $50,000 gain on the put option that offsets the $100,000 loss that I have in the portfolio, which nets me about a $50,000 loss. So, and anything further will basically give me roughly the same amount. So if I lose another $50,000 as the market moves 15% lower, I'm going to gain $100,000 back on my put option, which again brings my net loss to about $50,000. So my losses are capped at roughly about $50,000, no matter if the market goes down 15% or 20% or 100%. My risk is limited to about $50,000 out of my $1 million portfolio. Not a bad result, in my opinion, if the market really does sell off significantly over the next 3 months. So next, what I want to take a look at is the comprehensive insurance. What does that look like? So this is, again, same $1 million portfolio. I'm going to use the same instrument to sell, to hedge with. But this time, what I'm going to do is I'm going to buy 7 contracts of the 2-month 60 delta put. So an in-the-money put, much more expensive. Instead of $17,000, this now costs me $36,000, which is 3.68% of my portfolio. So significantly more than double what I paid for the catastrophic insurance. So same thing, same portfolio, $1 million portfolio in the different scenarios where the market moves higher and lower. So in this particular case, if the market stays exactly where it is, before I lost $17,000, I lost the full value of the put option. So I actually lost $17,000. Here, I'm actually only losing $16,000. Even though I paid significantly more, and even if the market doesn't move, the comprehensive insurance, because it's an in-the-money option, doesn't decay as much, and there's some intrinsic value to the option. So even if the market doesn't move, I actually lose less money with the significantly more expensive insurance than I do with the cheap insurance. So that, I think, for most people is a little surprising. Next, as you can see, as the market starts to move lower, even if the market moves 5% lower, I lose $50,000 on my stock portfolio, but I gain back 35 grand on the comprehensive insurance. So now I'm only risking about 14 grand. So instead of losing 50, I only lose 15. And if the market starts to move lower, 10%, I make $86,000 back. So I'm now only down 13 grand. And as the market moves 15% lower, I make $138,000 back. So now I'm only losing $11,000. So the only difference here, though, is that the fact that if the market does move higher, I lose 36,000 instead of 17,000. So here I would, instead of making, I make $13,000 when the market moves 5% higher, as opposed to in the previous example, I would make $32,000. So effectively what I'm doing is I'm giving up a little bit of upside for far better protection to the downside. So those are the two different vehicles that you can hedge a portfolio with. And I want to show this to you in an actual example. But before we go through the actual example, I want to talk about hedging tips and best practices. So just to reiterate, constant hedging your portfolio is not cost efficient. So you only want to do it when you truly expect the market is going to correct with a high amount of certainty. And in my opinion, you're better late than early, because if you're anticipating it and it doesn't happen, you're losing 1%, 2%, 3% of your portfolio just waiting. And that's not something you want to do. You only want to buy insurance, in my opinion, when the sell-off has started to happen. Another thing is you can actually offset the cost of hedging by selling cover calls on your portfolio. So if you're buying protection and it's costing you 1% to 2% of your portfolio to do so, you can sell some cover calls and try to recuperate that 1% to 2% back. Especially if you feel the market's going to correct, you can get pretty aggressive with your cover calls and be able to collect close to the premium that you're costing to buy that put option. Lastly, index options, in my opinion, provide some cost efficiencies if you do have a relatively larger portfolio. And for me, and this is my personal opinion, this is not by any means, because it depends on your outlook of the market as well. But buying in the money puts, in my opinion, does provide you far better protection. You have less time decay with those in the money put options. And even if the market doesn't move very much, you're better protected with that in the money option than an out of the money option, which most people go for because it's cheaper. So lastly, let's go ahead and use our live portfolio hedging using options play. We're going to use the P&L simulator. I want to show you how to calculate the number of contracts, show you how to evaluate the hedge for all different types of outlook on the market, help you compare the two different hedges, and then lastly, show you a little bit about timing the hedges with the trend indicators that we have. So let's go back to, I'm going to use SPY. This is just an easy example that everyone's familiar with. This is the S&P 500 ETF. And what I'm going to have here is I'm going to show you I'm going to simulate your portfolio with shares of SPY. And what I'm going to do is I'm going to buy a different put option. So I'm going to buy a May, which is roughly a 2-month put option. I'm going to buy a out of the money put option. So I'm going to buy about a 265 put. And then what I'm also going to do is I'm going to do the same May, same May, I'm going to go a little higher. I'm going to go up to about 280 put. So as you can see, on a $27,000 portfolio, buying one put option will cost you $411. Buying an in-the-money put option will cost you $949. Now, let's take a look at a realistic portfolio. So what I'm going to use is our risk and investment calculator. This is where you can use the I want to invest and put in your actual portfolio value. So let's say you have a $400,000 portfolio. So what this does is it automatically calculates roughly how many shares of SPY you would have. So as you can see, 1,400 shares will get you to $399,908, which is very close to $400,000 portfolio. Here, it'll calculate that I need 15 put contracts to hedge that $400,000 portfolio, or 15 put contracts of the in the money to hedge that $400,000 portfolio. And just for round numbers, actually, let's make it 500,000 so it's easy to calculate. So a $500,000 portfolio. Here, the May, which is quite a long hedge in my opinion, costs you $7,398, roughly 3%. Here will cost you $17,000, so a little over almost 4% of your portfolio on buying the in-the-money put option. So what I want to do is I want to say SPY is at 275. What happens if this stock stays just where it is, meaning the market doesn't move much lower, it stays around 275? As you can see here, the portfolio itself would basically be flat. If you had bought the the catastrophic insurance or the cheaper insurance, you would lose $7,398. So your $500,000 portfolio would take roughly a $7,300 hit. And if you bought the expensive insurance, even though it cost you more than double what it would cost, you would lose roughly about the same, $8,000. So your portfolio would take an $8,000 hit. So this is really where, if the market stays where it is, both insurance policies will get you roughly to the same amount. Now, if the market moves even just a little bit lower, let's say it moves modestly back to, let's say, halfway between this rally, this 260 support and 280, let's say it moves down to 270. So just a modest pullback. As you can see, your portfolio now is down roughly $9,000 on a pullback to about 270. Not a big pullback, but you're still losing $10,000. If you bought the cheap insurance, you'd lose an additional $7,300. So now, instead of being down $9,000, you're down roughly $16,000. So not a great result, in my opinion. But again, that's what catastrophic insurance provides you with. It only provides you with insurance if you get a major sell-off, as opposed to on the catastrophic or the comprehensive insurance, you get a little bit of gain, a $918 profit. So you offset your gains, your losses from $9,000 to a little, maybe $8,000. So not a huge gain, but still something to show for it. So that's really where the expensive insurance starts to play. It starts to provide you with insurance much, much earlier. So we talked about, if we do get a pullback, I think 260 is probably a realistic level. It's about 5% correction. I think that that's a healthy correction for a market that's done nothing except for move straight higher for the 3 months prior. So I think 260 is probably more of a realistic move. So if you get a modest pullback of about 5% to 260, you're losing $27,000 on your $500,000 portfolio. So that's a significant chunk of capital to be losing. And if you bought the comprehensive insurance, you make $1,600 of that $27,000 back. So a very small fraction of it. Versus if you bought the comprehensive insurance or the in-the-money put option, you make $18,000 of that back. So now, instead of being down $27,000, you're only down roughly about $9,000. So this is really where the comprehensive insurance really comes into play, even on a modest pullback. Now, this is where we can start exploring what happens if things start getting much worse. Maybe Brexit comes out to be a lot worse than we thought it was going to be. Maybe this starts to pull back to maybe 230, which is where we were just at in December, 235 rather. So let's say we pull back to that 235 loss. So now you're losing $58,000 on your portfolio. This is where the catastrophic insurance will start coming to life. So you're going to be able to recover roughly half of that, $32,000, versus the comprehensive insurance insures almost all of it. So when you lose $58,000 in your stock portfolio, you gain 49 of that back on the put option. So now you're down, instead of 58,000, only about 10,000. And as you can see, as the market continues to go lower, and maybe let's just do a really crazy hypothetical. If let's say this goes back to like 240, as you can see, you get significantly better performance on the catastrophic insurance policy. I'm sorry. You get significantly better performance on the comprehensive insurance policy, the in-the-money put versus the out-of-the-money put. And then let's say the market does the exact opposite of what we're saying. Let's say it starts moving back up to 280, 290. Maybe it goes back to 290, near its all-time highs. Here, you make $27,000 on your portfolio. This, you lose $7,000 on the catastrophic insurance. Here you lose $17,000 on the comprehensive insurance. So instead of making $27,000 if you didn't hedge, you'd only make $20,000 if you bought this insurance, the cheaper insurance, but you'd only make about $10,000 if you had bought the expensive insurance. So that's the downside to buying the expensive insurance, is if the market does the exact opposite of what you're expecting and simply moves higher. However, I will say, if the market is back up at 280, 290 in the next few weeks, so let's say in a few weeks, by let's say the end of March, the markets are back up to about 290. You're not truly losing $17,000. you're more likely losing some piece of that, but not all of it. Because I would say that if the market is back up to 290 in the next few weeks, you would be getting out of this trade altogether. No matter whether you bought the cheap hedge or the more expensive hedge, it's time to remove that hedge, because your thought that the markets are going to correct is unlikely going to happen, or at least not in the same fashion that you expect to. And I would suggest that you simply pull the plug, and instead of losing 17,000, you lose 13,000. Not a great result, but still you are not losing 17,000, you're only losing 13,000. So I will say that you're not necessarily risking the full amount. You will be likely risking some of that as part of your hedge. So that is really how you can utilize this tool. And just one quick example to show you guys how we set this up, to remind you, if let's say instead of using SPY, you use QQQ, you can use any index that you think is the right hedge for your portfolio. You simply type it in. You have your stock portfolio that this is your current portfolio that mimics. You would always create any long put, any two puts against each other. You can choose different puts from different expiration dates. But I always recommend that you have one in the money put. So let's say you have the 175 put versus maybe a 165 put on a stock that's trading at 171. You use our risk and investment calculator. You would simply plug in the dollar amount of your portfolio. So let's say you have $1 million portfolio. It will mimic a $1 million portfolio for you here on the right-hand side. It will show you the number of contracts that you need to buy to hedge your portfolio with the cheaper insurance, with the more expensive insurance. And you simply use the P&L simulator to say, if the market was to correct lower back to this roughly 155, 152 support level, how much money do I lose on my portfolio? Here, $113,000. How much money do I make back on the hedge? 62 grand versus 99 grand. And you'll be able to instantly see what your expectation is and what happens if it makes that correction in the next, let's say, month. So let's say the market moves down to 152 1 month from now, as opposed to until April 18th. How much is a hedge worth? You can still calculate that very easily and see what your potential outlook is, and be able to very quickly see, hey, which strategy is best suited for me, which expiration, which strike price plays out for the outlook that I have on my account. And this allows you to be self-sufficient in being able to pick a hedge and actually analyze it and be intelligent in being able to trade this in your actual trading account. And once you're ready to trade that, you hit the trade button, and we have the information on how to enter this trade into your broker's platform. So with that, I want to thank everyone for taking the time out this afternoon. I really hope that this is useful and timely for users, especially given the current market conditions. I know most of you answered in the first poll that you are concerned about a correction. Like I said, if you have the ability to move into cash, then you should certainly do that. But if you don't, this is the type of analysis that you need to run your portfolio through in order to decide if a portfolio hedge is suitable for you. So with that, again, thank you everyone for taking the time out this afternoon. What I'm going to do is I'm going to open this up for Q&A. If there's any questions, please type them in the chat window, or put them into the Q&A window, and I'll answer as many questions as I have time for. And just a reminder, we are not going to be doing the webinar next Thursday. Next Thursday, I am traveling, unfortunately, so I'm going to have to cancel that. So we're going to push next Thursday's webinar to the following Thursday on the 21st. And I will send everyone an email after this to remind everyone of that. So with that, let's just look at some of the questions here. I know there was a few while I was in the webinar. So there's a question here from Ian saying, why not sell a call and use the premium to buy the protective put? And that is absolutely correct. That is one of the best ways to mitigate the cost of buying a put option or buying a hedge, is selling a call. You can sell a call on the existing positions that you have. You can sell a call option on an index. There's lots of different ways that you can generate some income to pay for your hedge and make it less expensive. So just to reiterate, what Ian means by this is, let's say I'm going to buy this April 18th 175 put. What I can do then is at the same time maybe sell a 175 call. So instead of costing $34,000, I'm actually going to take in roughly $13,000 in income. So what that nets out to me, instead of costing me 34 grand, it'll only cost me about 20 grand. As long as the market doesn't move significantly higher, this strategy will allow me to outperform just outright buying that put option. So very good comment, Ian. That's exactly how we would typically use using a cover call to sell using a cover call to generate income to purchase a put option. Kush is saying there would not be enough buyers for the call. Not sure what you mean by there will not be enough buyers for the call. Also, it has to be very liquid. ETFs are generally not. I'm not sure what ETFs you're trading, but most ETFs are far more liquid than individual stocks because ETFs are collections of far more liquidity, and the liquidity of an ETF or rather the liquidity of an ETF option is just simply a factor of the liquidity of the ETF. So any broad-based index, I think you will find plenty of liquidity, or at least you'll be able to find an ETF with enough liquidity. Mike is saying, how's the technical score calculated? Is it based on specific studies? So the technical score is calculated off of 6 different technical indicators. It's 6 technical indicators, and what that generates is a score, and all stocks are ranked based on that score from highest to lowest. That's how we get a sense for relative strength. That's how we get a sense for how stocks compare to each other. And the technical score is on a rank of 1 to 10. 10 are the strongest stocks in the market. 1 are the weakest stocks in the market. So that's how we go about calculating the technical score. There's another question here. Do you use standard deviation or sigma as inputs to choose option limits? So when I refer to using delta to choose your different hedges, so 30 to 40 delta and 50 to 60 delta, that's already accounting for standard deviations through the implied volatility, because delta is calculated off of the expected implied volatility of the option. So indirectly, it is. What I mean is, if market is about to correct, there would not be enough buyers for cover calls that Ian was suggesting to sell. So that's where I think that there might be a bit of misunderstanding as to how markets are made. Markets are made by market makers that don't really care what direction the markets are headed in, because they're always hedged. They don't care whether the market feels the market's going to go higher or lower. Market makers will make a two-way market, and regardless of what your views are on the market, those calls will be as liquid whether the market feels it's going to correct or not. So that's my suggestion to you, is don't worry about where you think the markets are heading, whether there's going to be enough buyers for it. That's the job of a market maker. And market makers will always make a market as long as there's liquidity in the underlying stock. Open interest really doesn't give you any indication of liquidity. High open interest does mean high liquidity, but low open interest does not mean low liquidity. So that's, again, a very big fallacy of open interest. Don't use open interest as a way to gauge liquidity. The spread between the bid and the ask price is a much better gauge for liquidity. If you have a lot of individual stocks, do you convert them to an index fund first? No, you keep your individual stocks. So what I was saying is, take a look at the makeup of your individual stocks. So they're fairly well diversified across the board. If they are, then you can just buy an ETF index, an ETF on a broad-based index like SPY or QQQ, or you can buy an index ETF. Index option if you have a relatively large portfolio. So William, you do not need to convert anything to anything. You can just straight up buy the puts on your portfolio. How much is too wide bid-ask spread? Great question. So we actually have an indicator for this. Well, on any strategy, we will tell you the bid and the ask price, and we have a strategy checklist that checks that the bid-ask spread is high or not, because it depends on the price of the option. Because if you have a 10-cent option, is a 5-cent wide spread too large? I would say yes, because it's a percentage of the underlying premium. So we actually check that for you. It's on our strategy checklist. So for example, here for QQQ, you'll see that it has very tight spreads between 579 and 591. So that's why you have a spread and liquidity of very good liquidity. But if, let's say, we move over to something like Harley Davidson, this is a relatively small cap stock. If you go to trade, as you can see, this is trading at 260 by 360, which is a much wider spread. And that's why our strategy checklist looks at the spread and liquidity of this and tells you that the bid-ask spread of this trade is very large. So there's a lot of inputs that go into it, but that's why we actually have a tool on our platform that determines whether the spread is small or large. Kush, you're very welcome about the open interest concept. Nicholas, thank you so much. I really appreciate it. Any other questions regarding hedging a portfolio? Or, I'm also curious to hear your thoughts as far as where you think the markets are headed and how you plan on protecting yourself against a downside move. Raymond, thank you so much. I really appreciate it. Raymond, thank you for coming to our webinars every single week. For those of you that don't know Raymond, he's been a huge supporter of Options Play here every single week to learn and provide questions. And I hope that for those of you that are new to Options Play, you guys find some value in these educational webinars that we provide. We do this to help you learn how to trade options. And hey, maybe hedging is not for you. I'm not suggesting that everyone needs to trade every single strategy that we do every single week, but we do these every single week with different topics so that you do come across different strategies that make sense for you. Some of you are income traders and you like to sell cover calls. Make sure you attend those, like the one that's coming up next. We're talking about selling cover calls. Very, very popular strategy. Other of you like to speculate or trade more advanced strategies. We try to cover as many strategies as possible so that everyone gets to learn about their specific strategy. What about buying a VIX call spread as a hedge? Sure, but I would argue to you, if the VIX goes up 10%, what is the impact to your portfolio? I don't know how you'd be able to calculate if the VIX went up 10%, how much of your portfolio would that hedge? Would that hedge 1%, 10%, 100% of your portfolio? You don't know. And that's the problem with using VIX to hedge your portfolio. It certainly will be a hedge, but as far as how much of a hedge you're actually getting, that is not something that you and I can calculate, because you don't know how much VIX will go up if the market goes down 5% over the next, let's say, 2, 3, 4, 5 weeks. There's no formula for that. Versus if the market does correct 5%, and you bought a put option on SPY, you have a very good sense of how much you've actually hedged your portfolio with. Alan, thank you so much. Brian, thank you so much. Joseph, I appreciate it. Larry, same thing. I really appreciate it. Mike is saying your CCI chart has overbought and oversold lines as well as red and green fill. However, when I add the CCI study, it doesn't have any of that. So Mike, we only have the red and green line for the trading strategies that we create. It's not something you can add on your own. It's just something that we kind of build to make our own trade ideas stand out a little bit. Unfortunately, that's not a feature that you can just add to any chart at this point. Brendan saying, thank you. Your webinars are very informative. Thank you so much. I really appreciate it. And again, if for those of you that did not follow along, you came late or you thought I was going too fast, we do send the recordings with the slides so that you're able to follow along at your own speed. Jason, thank you so much. I really appreciate it. Any other questions before I sign off for the day? If there are no other questions, again, I just want to thank everyone for taking the time out this afternoon. Again, just a reminder, we are going to postpone next week's webinar to the following Thursday. So I will send out a reminder, everyone, to let people know the next week's webinar is canceled, but we are pushing that out to the 21st of March. So thank you so much for taking the time out this afternoon. I hope you guys find this webinar useful, perhaps just by a stroke of luck. Markets sell off and you are able to utilize this strategy. I hope it doesn't sell off, because if it does, that means that there's going to be some losses in your portfolios, including mine. So I hope the market doesn't sell off, but if it does, I hope that you guys are now prepared for how to actually protect yourself against that. So thank you so much. I hope you guys have a great evening, and I'll see you guys in 2 weeks.